My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Shana Sissel, who I believe my colleague named the Queen of Alternatives. And I think you took that from Cynthia. Shana, for those who are not familiar with your background, introduce yourself. Who are you? How'd you get interested, involved in markets? And why alts?
Sure. So yes, Cynthia did call me the Queen of Alts, and I took it and ran with it because why wouldn't I? I have been in the industry now for 22 years. And I started off as a financial advisor and became absolutely fascinated with building portfolios and markets. So really wanted to take my career in a more analytical direction so that I could run portfolios and be more involved in investment selection. And have spent the majority of my career doing just that for both financial advisors and large institutions. You know, some of the bigger firms that I've worked for in that respect have been firms like Russell Investments, Mercer Investments, the investment management arm, not the investment consulting arm, Fidelity Strategic Advisors, and Orion Advisor Solutions. And in September of this year, I launched my own firm, Banrian Capital Management, with the focus being providing scalable access to alternatives for financial advisors who want to be able to allocate to alternative investments across their entire book of business, not just to clients that can meet the hurdle of accredited investor or qualified purchaser. I think that that's a real need in the industry, and there are solutions out there that actually can do that. So we also help asset managers in the space, better put together their materials, improve their products and the like to make them more tangible and more accessible and understandable to advisors. So we work with both advisors and asset managers, and our goal is really to make alts accessible for everybody. So that's my key focus. And you asked why alternatives? Well, it's kind of a funny story. I really became passionate about alternatives at a time where you would not think someone would become passionate about alternatives. I was working for Russell Investments for their hedge fund group, doing manager research. And I started in July of 2007. And the very first assignment I got as a brand new junior analyst who had never, ever worked in the hedge fund world before was to figure out how to replicate the returns of a asset-based lending hedge fund that we had requested to redeem from, and they could not meet our redemption request. So they gated us because they had no liquidity. And so I started doing a regression analysis to find ways that we could use derivatives to hedge our exposure to them. That is seemingly very complicated, but what I was doing at the time and didn't realize it was hedge fund replication, which became a thing like a year later when Goldman Sachs launched their Goldman Sachs hedge fund tracker or alternative tracker. I can't remember what they called it. And then you had a gentleman from MIT whose name is completely Alpha Simplex. His name is completely not coming to mind right now, but it's sort of irrelevant. It became very clear to me that alternatives were kind of the canary in the coal mine because of where they play an important role in markets. But more importantly, through the financial crisis, a lot of alternative strategies worked. And we actually just saw that happen over the last year as well. And when that happens, people tend to take notice. Now, unfortunately, when the financial crisis happened, that was exactly when the SEC kind of changed the rules that allowed for alternative mutual funds and ETFs to become available. And there wasn't a lot of education. So a lot of money came in and then a lot of money came out because we entered a 10 plus year bull market. But it really stuck with me, all the lessons I learned at that time. And it was such an influential time in my life and my career that I've become incredibly passionate about how important alternatives are in terms of building portfolios, risk management, diversification, and all that good stuff.
You had mentioned the gating and the liquidity aspect of it. How tied are alternative investments kind of broadly? And I understand it's a big term, right? There's a lot of things you can fit under that, but how does liquidity factor into what makes a strategy or an approach alternative or not?
It's not the liquidity that makes it alternative. Phil Huber, who is a well-known alternative expert with advisors, is somebody who kind of coined this idea of it's not what they are, it's what they aren't. Basically, anything that isn't long-only stocks or long-only bonds is alternative by definition. So historically, traditionally, when hedge funds began, they actually hedged, and that's they were long and short, and they used derivatives to kind of hedge risk. And now it's gotten to be so much more than that. But you just kind of have to think of alternatives in that respect. Is like if it's not long only bonds in the public bonds or long only public equities, it is alternative. And liquidity can affect all kinds of parts of the market. You know, there are some things that are actually quite liquid, like long short equity can be daily liquid. That's why you see a lot of long short and hedge products in 40 Act mutual funds in ETF form. But then there are other things like in the case of the fund that I was tasked to do work on when I first started in the business, a firm called Sagecrest Capital, which doesn't exist anymore, but it did asset-based lending. And so what that means is that they would loan companies money and use as collateral things like the desks in the office and the chairs that the employees sat on and the computers and the printers. And that is not something that can be liquidated in an hour. If there is a problem and you need to, take that collateral and liquidate it, that takes a long time. So liquidity needs to match that. And that's actually a really important component of alternatives is if you do invest in the space, especially in these private funds, is really understanding what the underlying investment is. And like realistically, can you liquidate that in a day, in a week, in a month, or so on, and make sure the liquidity terms of the fund match the liquidity terms of the underlying investment. And in the alternatives world, there's a lot of different things. Peer-to-peer lending is an example of an alternative credit product. A lot of hedge funds do that. And there's a number of really unique parts of alternatives that go even beyond, traditional investments, antiques, music rights. All of these things fall into the alternative bucket. And all of those things are not something you can just trade on an exchange tomorrow or right now and be able to sell it very easily. So that's why liquidity comes into play.
You said this idea that anything that's not long only is alternative. I'll push back a tiny bit, only in the sense that, like, I've done these studies. If you look at these indices around long short strategies, they tend to on average correlate to like the long only consumer staples ETF, for example. Presumably, it's more than just whether it's long only. It's also about correlation. How do you think through the correlation aspect of what makes something a true alternative versus just beta in disguise?
Well, there's two parts to answering that question. The first is when you look at public indexes, especially if they're available in a completely liquid form, they're probably not replicating long short. They're probably long only, which is why they don't actually correlate to a long short strategy. So you have to think about that. What are you trying to replicate? And can you do it by actually implementing the strategy? If you're not actually long and short things, it's not going to look like long short and it's not going to correlate. But it does come down to correlation. And that's actually the interesting part of alternatives. I spend a lot of time educating advisors in particular on the space. And one of the things I focus on is looking at correlations, because there are things that are quote unquote alternatives, to your point, long short, which actually have quite a bit of equity beta. It's reduced equity beta, but it's still equity beta. And when I'm building alternative allocations, I'm actually looking to not have equity beta. I'm looking to do things like market neutral, which is when you go long and short in equal amounts, so you're not making a directional bet, and your beta ends up being zero. And then there's 10 million different ways you can do market neutral, and some ways actually make sense and others don't. So, for example, one of my favorite ETFs, BTAL, is a market neutral volatility fund. So it goes long, low volatility stocks, and it goes short, high volatility stocks. And there's plenty of academic research that supports that low vol has persistently beaten high vol over long stretches of time. And so a strategy like that in market neutral can make sense because there's persistence in the signal. But then I've also seen somebody try to do market neutral value where they're looking at PE, and those strategies don't do so well because the factor and the persistency of outperformance just isn't there, especially on a sector level. So there's so many things you have to look at. You want to look at correlations. You want to look at, does the strategy they're implementing make sense in terms of being able to provide persistent returns. And there's so many different offerings. So an example, I don't consider private equity and private credit to be diversifiers. They're a different mousetrap to get similar risk exposure and maybe better returns because you're dealing in private markets for equity and for credit. But they aren't necessarily uncorrelated to equity or credit other than the way that they price their products. So they look less volatile, but they're still pretty much tied to those markets. So you have to look at it. It's a very nuanced world, and it's such a big universe, and there's so many things that fall into it that it can be overwhelming for a lot of people. So I always say focus on looking for things that have low correlation to traditional equity beta, traditional fixed income, because that's where you're going to get your best diversification benefits.
I've got to assume that it's been harder to find the strategies that really are diversifiers in that sense. I mean, let's face it, the last decade, as I've noted continuously, really since QE3, has been dominated by just, cheap beta, large caps. Alternatives became seen as alternatives to making money. And a lot of alternative managers, I'm going to make the assumption, probably started having more beta-like characteristics because they had to, right? Because it was that kind of a cycle. Do you find that it's harder to find real alternatives now because a lot of the real alternatives maybe just aren't in existence because the cycle didn't favor them? What's sort of the state of differentiation currently?
So I would say it depends on where you're looking. So it's never hard to find real alternatives if you are an accredited investor or a qualified purchaser and can invest in private product. There is a wealth of unique solutions out there, and you'll never have a problem finding, true diversifiers in that space. The problem is in the 40 Act space, the 40 Act interval funds, 40 Act ETFs, and 40 Act mutual funds. To your point, this is a little bit of a history lesson that may bore some people, but I tell it often because I think it gives a good perspective on sort of the problem. The SEC relaxed the rules about use of leverage and shorting, I believe, in 2007. And the way I remember it, and I'm sure anybody who was around at that time will remember it, is that every asset management firm out there launched 130-30 and 120-20 funds. This is because the relaxation of the rule allowed for as much as 30% leverage on your NAV. And so you start to see these products. Now, I challenge you to go find any 130-30 or 120-20 products because they barely exist anymore because they came and went because they were equity of one. So they offered no diversification benefits. They were just taking advantage of a rule and thinking that they could amplify their long returns and maybe get some alpha out of some shorts. It turns out that most long-only asset managers are really bad at shorting. So it didn't really work. And most of those funds went away. At the same time, a lot of hedge fund managers converted their products to mutual funds, but then they didn't attract assets, and so those went away. So a universe that existed of these alternative mutual funds products, and it was more mutual funds than ETFs, largely because there's even more restrictions on what you can do in an ETF as it comes to leverage and shorting, and then there's also the problem of having to have full transparency, at least for until recently, and people who short don't like that for obvious reasons. If we learn nothing from the AMC and GameStop scenario, it's you don't want people to know you're short. So having that transparency was a problem. But they did happen in mutual funds. And so if you look back at, say, 2009, and you look at the universe of these types of alternative mutual funds, there were thousands of them. And now there's only a couple hundred. So yeah, it's a lot harder. And the asset managers who try to focus on this space tend to fail because alternatives haven't attracted assets at all. The ones that have succeeded are the firms that have complementary private product or more traditional products. So firms like AQR, like First Trust. So these are firms that have a lot of alternative product. JP Morgan had a lot for a while because they converted a lot of their hybrid funds to mutual funds, but less so. But that's what you see that's left are companies that could afford to take losses on products that didn't attract a lot of assets until about a year ago when all these products got noticed because they were doing so well. but there's not a lot of offerings out there. And the ones that kind of stand out in the 40X space are sort of the global macro managed futures kind of products. There's a lot of those. They make a lot of sense and they have really good track records and low correlation to traditional products. So those have kind of stuck around, but things like long short equity or equity market neutral, they kind of came and went. And so there's not as much offerings now because they didn't attract assets. But I think that's going to change. I really do. I think people who are currently in that space will start to see assets be stickier and people learning how to use them. But to your point, the offering is slim pickings, particularly in the 40X space.
Yeah, and I think this is really I think it's interesting for the audience in the sense that I keep going back to zero interest rate policy was the enabler for large cap to dominate the investment mindset, right? Mm-hmm. So now you're off the zero interest rate bound. QE is not coming back anytime soon because optically it'd be terrible, barring a crisis. So there should be a pendulum swing back towards alternative and active. And I think the other part of this is that there's a concept, Shana, you may have seen it. I think it's called the Grossman Cyglitz paradox. Mm-hmm. The idea basically is that you need active for passive to work and passive for active to work, because what happens is eventually as people go into anomalies, trying to arbitrage these anomalies and create strategies, alternative strategies around these anomalies, eventually the anomalies go away because everyone's chasing the performance from that manager, from that approach. Then passive becomes all the rage. So then the active players go bankrupt effectively. Mm-hmm. And then the anomalies come back, right? So to the extent that alternatives are more than just about hedging, but also about trying to identify anomalies to generate alpha, there probably are more anomalies than we've seen in a long time because there aren't that many players going after them.
Yes, and there are some strategies, to your point, where even if a passive anomaly exists, they can take advantage of that. And the example I gave with BTAL is a perfect example. It's one of the few alternative funds that has been able to gather assets that did do well, even during periods where equity was going straight up, because it's taking advantage of, a persistent factor of low vol outperforming. And as long as that relationship continues, then a market neutral strategy can succeed because you don't need both to go up. You don't even need one to go up and one to go down. You just need the side that's long to go up or down less than the side that you're short. So BTAL in particular, if every name in their portfolio was negative, as long as their low vol names were less negative than their high vol names, then they would have positive return. So there are types of strategies that can take advantage of anomalies even in passive markets. But again, few and far between. And to your point, a lot of alternative strategies are taking advantage of anomalies in the market. That's the whole point. They're hedged and they're arbitraged. But I do want to point out, if you look at these strategies and you look at a diversified 60-40 portfolio, a lot of people like to say 60-40 is dead. I don't like that because I don't think it's dead. I like to say it's evolving. And if you say, look at a 60-40, and if I have $1 million, put $800,000 in my very traditional 60-40 portfolio, but then I take $200,000 and I put it in a really well-diversified, low correlation alternative portfolio. Even during that period where passive outperformed, where you had, very low interest rate environment that really favored large cap stocks, to your point, where equities just went straight up and, and alternatives, quote unquote, underperformed. Even in that environment, if you use that scenario where you have 800,000 in the 60-40 and 200,000 in this 20% alternative allocation over that 10-year period, you actually would have performed in line or slightly better than a traditional 60-40. Now, I have the numbers, I've run it. Then it's not going to blow your socks off and you probably wouldn't even notice. It's like 20 basis points on an annualized basis, which over 10 years actually adds up to a lot. But on a year-to-year basis, you probably don't even notice. But it reduces the risk of the portfolio by about 150 basis points. And this is if you're using like 40 Act mutual funds. It's even more improved if you use private funds, if you can, because you have just better product in that space. But even in that environment, the diversification benefits are there. It's just nobody wants to put them in portfolios because A, you really have to focus on that part we talked about earlier, the low correlation or no correlation products, which are hard to find unless you know what you're looking for. They're poorly categorized. Morningstar has some of them in tactical allocation, and you wouldn't think to look for them there. So they're not well categorized. So unless you know what you're looking for, they're hard to find. But they do work. They do have diversification benefits. Even in that time period, you would have still done better than the traditional 60-40. And then in 2022, when everything hit the fan, those products absolutely would have significantly improved your portfolio returns. Most of the products that I allocate to were up double digits in 2022.
I think most people, just because of the headlines, they think about alternatives as benefiting from tail events in equities, right? Kind of the extremes, right? You hear these stories of these funds that are up, 1,000% in 2008 or in the midst of the COVID crash. Is that a fair characterization that there has to be an element of some kind of benefit or convexity to a tail event in equities, or are there alternatives that have nothing to do at all with sort of extremes in beta?
There are plenty of alternatives that have nothing to do with extremes in beta, but there are definitely alternatives that take advantage of anomalies. Like almost every scenario of which you hear about some big hedge fund that made ridiculous amount of money on a tail event, almost all of them are like a macro fund who just took a massive bet. Those are also the bets that put hedge funds out of business. One of my favorite hedge funds ever was a firm called Everest Capital. Amazing emerging market firm, decades of amazing performance. And then in 2013, 14, can't remember the year exactly. I just remember where I was working. It was when I was with Fidelity. One of their PMs, the founder of the firm, decided to make a fairly substantial bet on the Swiss franc, and it blew up the whole firm. So Everest doesn't exist anymore because of that. But then there are, plenty of George Soros, who became very famous because his macro fund took a really big, sizable bet that completely paid off. So those exist and they make the headlines, but the bulk of the space is not that.
From what you've seen, Shana, what's sort of the split between alternatives where there's discretionary decision making versus quantitatively driven alternative strategies, right? Because to your point, right, it's easy to blow up if you're making a concentrated bet, like in the case of that firm. Whereas if you have a repeatable rules-based process, you may not have those similar dynamics.
In certain types of strategies, you certainly find more quant-based. So equity market neutral is an area where it's almost always rules-based. There's not a lot of discretion there. The most successful market neutral products are almost certainly quant-based. You see that a little bit in long short, but then there are other spaces where it's hard to do quant. Some really famous hedge funds like Renaissance, they're kind of a multi-strategy kind of thing that uses quant. AQR does equity, and that's mostly quant. In the credit markets, you don't see it nearly as much because it's hard to build an algorithm around a market that is hard to trade. You also don't see that in fixed income in general. There's not a lot of rules-based quant fixed income bond funds. It's just really hard. And some of the global macro, which is where you get these tail events, you have a lot of active, but you can do a lot of quant in that space too. You got to look at sort of the different ways that things can be approached. It's no different than traditional markets, mutual funds, large cap growth. You have quant guys, you have active guys, passive guys. You can do rules-based there easily. It really just comes down to how easily you can trade the market. And that's really comes down. So most strategies that can use derivatives and, publicly traded, whether it be futures, traditional stocks, bonds, currency, you can do a rules-based approach. When you get into some of the more esoteric asset-based lending, anything in that bucket, it's hard to do rules-based approaches. So I would say it's about 50-50.
It seems to me there's this interesting paradox, maybe for lack of a better way of saying it, when it comes to alternatives that are focused on anomalies, in that, sure, you want to give anybody access to alternatives, but if you give too much access to a strategy which is designed to take advantage of an anomaly, then the anomaly goes away, right? Because then there's too much money chasing it. How should investors think about that dynamic, right? Because this is the thing, there is a degree of efficiency if you don't gate the amount of dollars that are chasing some particular factor.
True. And that would be a wonderful problem for alts to have. It's yet to happen. So I absolutely agree. If you're taking advantage of some sort of anomaly in the market, you have to gate it. So products like that, I'd like to see in a mutual fund or in a private fund vehicle where you have the ability to do just that. So that's where fund structure becomes an important part of the decision. I would say right now, most funds that are taking advantage of major anomalies in the market are doing it in the private markets. So it's less of an issue.
For the remaining minutes here, but please make sure you follow Shana Sissel. And again, if any of you want to come up and ask questions, feel free to click on that bottom left mic request button. And as always, I will have this conversation on all your favorite podcast platforms under that Lead Lag Live banner. Let's take a step back and talk about cycles for a moment. We kind of alluded to this idea that it's been a cycle of just large caps. That cycle, I myself believe, is probably over, which should make it a lot easier for anybody that's comping their performance against the S&P, even though you and I both know the S&P is not the right benchmark for most individuals. Mm-hmm. They naturally benchmark everything against the S&P. I always go back to that point. It's hard to beat the S&P when it's the only game in town. Okay, so maybe the game's changed. What are your thoughts on where we are in terms of investing cycles? Meaning, do you think that we're going to see sustainable movement into international, into emerging markets? Do you think we're going to see sustainable movement outside of passive, or are we going to go back to that old playbook, but maybe some small variations around it?
So it's interesting because I think a lot of people think that, this time is different, but there's actually, to your point, you said this earlier, and it's an important point. The active passive relationship, the international domestic relationship, US dollar to non-US dollar relationship, those are persistent trends that tend to last a good 8 to 10 years. And then when they flip for 8 to 10 years. Its value growth is the same. It's just, if you've only been in the industry for the last 10, 12 years, you've only experienced one period of this. I do think we're going to go back to a time closer to what we saw post-tech bubble, pre-financial crisis, which is when active management worked, international worked, emerging market worked. I do think we're going to get back to that period. It's going to take a couple years before we start to see people recognize it, because that's how it always is. People who recognize it early are the people who tend to make the most money. But the good thing about these particular relationships, as I said, is that these trends tend to be persistent for long periods of time. They don't flip on a dime. So I think we're entering that period. I think we're going to go through, somewhere between 8 to 10 year period. We like to call them market cycles. Of course, everybody hears that reference. Institutional managers always talk about how does a fund perform over a full market cycle. But yes, I do think we're entering that. We've seen this flip. We're in a very different environment where it's unlikely that we'll see zero interest rate environment and very low inflation environment anytime soon. I think we're going to be in an environment that's more advantageous towards value than growth. And I think active managers will be able to perform better. But that also means that this is a good environment for alternative product as well, where there is opportunity in the market to take advantage of arbitrage.
I never thought of it in those terms. I made that point before that it's all the same trade, because I'm with you on this idea that you're probably in a cycle that favors value over growth, which means energy over tech, which means emerging over domestic. I mean, all that is the same trade. And that was the playbook coming out of the tech wreck. I mean, there are, I think, some interesting parallels, but I had never thought about whether there's a link to a cycle for value being beneficial for a cycle for alternatives, right? That if there's almost like a style tilt that makes the alternative space in general more likely to succeed.
Yes, because value is usually a fundamental driven game. And if you're taking advantage in alternatives, you're taking advantage of, discrepancies and fundamentals. I think we have a question.
We do. Good.
Well, I personally have not done any work on the space, but I know Wisdom Tree in particular is really big in that space and has some great research in this respect. AQR does some great research in that respect as well. Love him or hate him, and I happen to love him. Cliff Asness has great work in this space. And so he has some really interesting research that he's done. But to your point, market, if you think about that post-tech wreck, pre-financial crisis period, that was a small cap, mid cap outperforming, value outperforming. So it was really advantageous to not be in market cap weighted indices. But then we got into FANGs, and then all you needed were those 5 stocks to work, and market weighted indices worked. So I think it comes down to things like dispersion of returns. High dispersion is good for active managers. Low dispersion is not. We've had a long period of low dispersion. And these are the kind of things you have to think about. Smart beta and the factor stuff, those can be interesting, but understanding which factors are more persistent, for example, low vol and momentum are pretty persistent signals, but value not so much. And understanding that aspect can be helpful. But those things tend to work, regardless of market environment. That's why they're so consistent in the way the relationships there. But as we go into this next market cycle, which I expect to be quite different than the last one, I think you have to think more creatively about making tactical decisions and using active managers where it makes the most sense. It almost never makes sense to use active management in large cap, never. But in the small and mid cap space, there's a lot of evidence that active managers can add value, fixed income, and especially in alternatives as well. There's really no such thing as passive alternatives. Well, let's just think about the analogy I was just making where I expect this. Every market cycle is not exactly the same but you can make comparisons. If you think about that post-tech wreck, pre-financial crisis bubble period, that was a gold energy bubble. Oil prices, I distinctly remember oil prices being, I have video of me on CNBC in summer of 2008, and oil's well over $100 a barrel. That was a period where oil prices were high. Gold did really well in that period. So there's no reason to believe that we're not entering a period. If you believe that we're moving into a period similar to that, value outperforms, small and mid cap outperform, international does better than domestic, that would be a period that could be advantageous to gold. Very well could be advantageous to commodity prices, which means in the alternative space, I'd want to be looking at, managed futures types of strategies that take advantage of commodities, ag strategies, things of that nature. And I think we're kind of going into that. And at that time, a lot of that was being driven by the development of China and all the building and just that nation coming to age. I think this time around, it's going to be more of a result of climate and ecosystem kind of things where people get concerned about having natural gas and oil, where that's coming from, and geopolitical events influence a little more, but that certainly is a favorable environment for commodities, and of which gold is one. Gold, of course, behaves a little differently because it is also a store of value and a hedge against traditional currencies. But in the broader framework, I can see this coming market cycle to be favorable to the types of things that would be favorable that we saw post-tech bubble.
Let's talk a little bit about the due diligence side, Shana. You've got the institutional backdrop, obviously, and you know how to sniff this stuff out. But, for those that are interested in alternatives that are not necessarily on that side of the industry or retail in general, what kind of things should they be doing when they try to evaluate whether something really is alternative and whether it makes sense to put in a portfolio?
Due diligence and alternatives is so much more on the private side than if you're somebody who's never done private fund due diligence and you're coming from sort of strategies that are 40 Act compliant, a lot of the stuff you have to do in due diligence of alternatives is sort of out there. Operational and personal due diligence on people becomes that much more important. And even then, sometimes it gets missed. I watched the Madoff special. I happen to have done a little bit of work on Madoff before everything blew up when I worked at Russell, and we passed. I can't say we were just smart, but it was one of those things where, like, in the first 10 minutes of reviewing the book, the pitch book, something didn't sound right. The strategy they said they were doing didn't make sense with the returns. And so we just were like, we're not going to spend any more time. I think in the private fund market, paying a lot of attention to the fine print in the hedge language, people being able to really explain and show you through trades how they're getting their results. We used to use the Alpha tool, and I think it's called Alpha tool in FactSet. It's been a while, where you can literally take returns and break it into parts and see if it makes sense with what the manager says they're doing. So doing some return decomposition. Operational due diligence. This is when, lockdowns became an issue. Like, you want to make sure it's not some guy in his basement. If they say they have a team, you want to go make sure there is a team, because a lot of that happens in the private markets because there's no regulatory oversight and you can get away with a lot. And so I spend a lot of time initially looking at funds, looking at the little things like that to see if I even want to do work on the investment side. So in terms of due diligence in the private fund world, focusing on the operational and like doing a background check on the manager themselves is more critical, especially in the beginning, before you start doing work on very complicated strategies. That's something I really focus on. And I wrote a blog post a couple of years ago for the Kaya Association on my top 10 keys to manager due diligence. And there are things like, if it seems too good to be true, it probably is. Things like, if it's persistently good or persistently bad, I ask a lot of questions, and I ask more if it's persistently good than if it's persistently bad, because that's more suspicious to me. One is you just aren't very good. And the other one is nobody's this good. So that's more suspicious. Things like, do you have audited returns? Do you participate in some of the regulatory filings? These are all things I worry about in the beginning before I do work. And in the due diligence process for private alternatives, that becomes more important. And that's when it becomes more important to work with a professional who has the resources to be able to do that kind of work. Because anybody can do due diligence on an investment. That stuff requires a little more investment and tools and just being able to hire private eyes and things like that. The average person is probably not going to want to do that or spend that money. Have I looked at it recently? It's not really part of my framework for how I build portfolios in the alt space, but I can speak briefly. Interestingly enough, a lot of that actually happened pre-financial crisis too. I remember sitting down, or even slightly after, sitting down with an emerging market manager who threw up some chart, and this is not new information, but people may find it interesting, that China is actually one of the worst performing emerging markets, even at a time where they were from an economic standpoint, one of the strongest. Mexico, in this particular case, I think it was 2012, was the top performing emerging market country over the last 10 years. And then for a period of time, Colombia was the best performing emerging market country. Poland, it's never China or India. It's always, to your point, some of these more nuanced places. The places I would be paying a lot of attention to if I was looking for kind of these outside the box are, to your point, some of those Latin American countries. I know El Salvador is a country that's undergoing a lot of changes under new leadership, where they're trying to kind of follow what Colombia did, in the late 2000s, early 2010s. And then people have been saying this forever, but I think it's even more relevant now, to your point with the lithium trade and things of that, is looking at a lot of the African nations where there's a lot of natural resources that are in demand, which can really be interesting. So those are the two places I'd be looking at. I think that's quite interesting. In the emerging market space, I also think that personal freedom will become a bigger issue. So an ETF out there that takes advantage of that in emerging markets is FRDM. I'm plugging my friend Perth's fund because I think it's a good product, but also taking advantage of to things that will be a tailwind in the next 10 years. I think as we've gone through all this COVID and as we've gone through a lot of revolutionary change across the world with the Arab Spring and things of that nature, I think those types of things will be more of a tailwind to economic prosperity in the future.
Given your experience on the institutional side, Shana, I'm very public and open about this point that I think most people in our industry are complete knuckleheads. And I say that having presented at CFA chapters and coming to the conclusion fairly early on that a lot of advisors are really just salesmen. They're not really intellectual about investing and portfolio construction. If we are in a cycle that favors alternatives, do you think it'll be almost easier for someone like you to identify winners because the industry maybe has been dumbed down by just cheap beta?
Yes. And I like to say, I think advisors, one of the reasons why I didn't pursue a career as an advisor, because that was my first introductory into the industry, is because I'm not cut out for that job. That job is so relationship heavy. It's so customer service heavy. I cannot deal with my dad calling me up and freaking out about the market and wanting to sell everything and having to do that every day, to be almost like a therapist to people, to be that trusted partner. I can't do that and be a good investor because I don't invest emotionally. Advisors are excellent at that part. But to your point, there are plenty of studies that show that if you're a really good advisor in terms of client service and relationship management, you're probably not a great investor. So yeah, I do think that more and more we're seeing advisors realize that. That's why we've seen the rise of TAMPs. That's a role TAMPs play, taking the need for the advisor to make those decisions out of their hands. That's why we've seen the rise of aggregators, because we have all these people that went independent and realized there was some value to having that home office investment team. So I think in the alternative space, there's plenty of evidence that shows that in the coming years, this is an area that is expected to grow substantially. And I think it is going to be advantageous to firms like mine and others out there that are building right now, that see this opportunity, that learned the lessons over the last 10 years, saw everything kind of come to fruition as you expected it to in 2022, and expect us to kind of see this renaissance in alternatives come to be. I do think that there is a lot of demand for these types of platforms, and that there's a lot of advantages and a lot of opportunities for us to succeed because of it.
One thing I've also always struggled with when thinking about alternatives, even though we reference value, is it's hard to know if an alternative is itself undervalued, right? It's like, how do you know if a factor is undervalued? You know when it's overvalued because the factor then goes away in terms of its, what it's trying to achieve from an alpha perspective. But I'm curious, is there a way that you segment across the alternative space in terms of saying, okay, this is a part of the alt space which is, in quotes, cheaper than other parts?
I don't think so, because a lot of what alternatives are doing is taking advantage of relationships, and they're taking advantage of persistent trends in a relationship. So I know I used it already, but it's still a great example of that low vol, high vol relationship, or momentum. A lot of global macro funds are playing on relationships between currencies, and they can take advantage of an undervalued equity market and an overvalued currency, and they're looking at technical terms. But a lot of alternatives is relationship between factors or between technicals, and taking advantage of that. So I don't know if you can necessarily say something is quote unquote undervalued unless you start looking at like the alternative space where it's less liquid, like antiques, like things like antique instruments. Like there's a fund out there that does violin investments, where those are the places you could take advantage of, say, something being undervalued per se. Private equity does a good job in the space. After the financial crisis, there was a boom, if you want to think about that, of alternative credit platforms. That's when peer-to-peer lending became a thing. That's when PIPEs became really popular. And for anybody who doesn't know what PIPEs stand for, it's private investment in public equity. Everybody talks about Warren Buffett being the greatest value investor of all time. Warren Buffett is a PIPE investor. He's not a value investor. He's taking advantage through that structure of undervalued opportunities in the market, but he's not doing it through public equities in the traditional sense. He's not just going out and buying stocks. He's doing a lot of PIPE investing. There's always that opportunity in every market. And so, like I said, after the financial crisis in the credit markets, you saw a lot of new things pop out to take advantage of banks not lending to smaller businesses as frequently, and, really strict credit standards, things of that nature. I could see something like that happening now. I don't know if I've thought about enough where the opportunity in the space is, because I don't really think of how to allocate alternatives in that sense. But if you were doing sort of a tactical trend, looking for some of those undervalued things, think about the things that are coming out. Blockchain, crypto is sort of like you don't want to touch it right now. But I've seen some really interesting alternative products that are using blockchain and crypto to do things like mortgage underwriting quicker. That's really interesting to me. That's something that's probably quite undervalued right now because it's getting caught up in the headline risk of blockchain and crypto. But that's where I'd be looking. I think there might actually be some really interesting opportunity in the wreckage that is crypto and blockchain right now.
Yeah, I don't disagree myself on that. Okay, I think that's a good place to wrap the space up. Everybody, please make sure you follow Shana Sissel here on Twitter. Check out all of her work and research. Shana, any other places that people can reach out to you if they want to just kind of pick your brain on alts?
Sure, they can contact me directly. They can go to the website, banrandcapital.com, info@banrandcapital if they want to send me an email. They can go to the website and learn more about what we do. I'm on Instagram. I don't know if you mentioned that. Finance Queen 2020, LinkedIn, all the usuals. I'm everywhere. I like social media. I'm probably way too active on it, but I'm easy to find. If you want to have a conversation, I'm always up to talk alts.
Thank you, everybody, for joining. Thank you, Shana, and we'll see you next time. Appreciate everybody.